we always talk about inheritance tax, don't we? And we're always talking to clients about it, and it's so misunderstood.
There's so much you can do if you've, be prepared to put a little bit of work in, talk to some advisors and...
Get advice early. April 2026, big changes for business relief and agricultural relief. So this affects family farms, small and medium-sized family trading companies.
The spousal exemption is powerful. Being able to give everything to a spouse.
Leave your pension until last. Use up all your other money. Sell all your other assets. Keep your pension intact. April 2027, what they're proposing is pensions become exposed to inheritance tax. So this completely is switched on its head. Hello, welcome to this episode of SRLV's Not Just a Number podcast. I'm joined by my most excellent colleague from SRLV, Elie Pippard-Kemp.
Hello.
We're going to be discussing the major changes to inheritance tax that were announced, particularly the ones that were announced in the October budget 2024, and what can be done. What can you do to get out of these inheritance tax problems? Welcome to the show, Elie.
Thanks very much, Kieron. Good to be here.
Yeah, well, I suppose we always talk about inheritance tax, don't we? And we're always talking to clients about it, and it's so misunderstood. A lot of people think they're paying it when they don't have to. It's 40%, so it's really expensive, and we got changes on the way. So in the budget, 30th of October 2024, it's etched in my mind. April 25, changes for non-DOMs and long-term residents. April 26, we've got business relief and agricultural relief changes. And then April 27, inheritance tax on pensions. Big changes. So I think perhaps to kick us off, Elie, can you perhaps just describe what's the current state of play for inheritance tax? What happens when you die?
So an estate basically has, each person has a threshold of £325,000. Yeah. So that's charged at zero, so tax-free. Mm-hmm. And above that, as you said, 40% tax. Mm-hmm. So, nearly half of the estate above the 325 is going to be going to the government. So there is also a spousal exemption available to married couples and civil partners. So that's hugely valuable because anything you leave to the spouse is free of tax, however much the estate is. And that nil rate band is transferable. So if you leave everything to your spouse on the first death, and then on the second death, they leave it to the children, grandchildren, heirs as appropriate. Yeah. You can carry forward the unused nil rate band. So effectively, a husband and wife, civil partners get 650,000 tax free.
650 grand, not too shabby. But I think the interesting thing about that is the threshold hasn't changed in years.
It absolutely hasn't. I can't remember how many years back, but it's a long time, and each successive government seems to just cap it there. So what was relatively generous and covered a lot of estates is getting less and less. What with property prices going up.
That's the big one, isn't it? Because a lot of people who live in the home counties or London, their estates are going to be worth more than 650,000 if they're homeowners. Yeah, but definitely.
Even the most humble of homes in South East is kind of coming up to that sort of value.
Yeah. Okay, so that's what happens when you die. It's death and taxes. It's 40%. It's expensive. How about lifetime gifts? What's the lay of the land for that?
So there are kind of two different types of gift, and I'll start with talking about what's known as a potentially exempt transfer, which is a gift you can make to anyone you want to, and you have to survive 7 years after making the gift for it to then become completely tax-free. The provisos there are that you can actually afford to give away what you're giving, and that you don't retain any benefits after giving it away. Yeah, so, for example, if you and your wife, you and your husband live in a family home, and it's just the two of you there, and you give that away to your heirs,
your children,
but you carry on living there rent-free, nothing's changed, it won't work. It'll just be part of your estate.
HMRC will say, they'll look straight through that and say, well, you haven't really given it away. You're still living in that house. What you've done is a bit of a joke.
If you have the money to pay a market rate of rent. You could give it away and carry on paying rent to your heirs, but a lot of people that
it's fiddly,
either
isn't
might
it?
not have the money to pay rent as well as giving the home away, or it perhaps doesn't work.
Well, the other thing you need to think about, I suppose, is if you're paying rent to someone, the recipient has to pay income tax
on that. So yeah,
it's not a good solution for a lot of people.
Absolutely.
I suppose maybe for people who are from outside the UK doesn't have gift taxes.
That's right.
So countries like America have a gift tax, and the recipient has to pay some tax on receipt of a gift. The UK doesn't have that. You can gift as much as you want.
You absolutely can. And just that 7-year rule, survive 7 years.
If I had £10 million worth of cash going spare, I gave it to you.
Oh, thank you very much. Just live 7 years. And
fingers crossed, I survived 7 years. No inheritance tax.
Absolutely.
Happy days.
It does actually taper as well. There are reduced rates between years 3 and 7, but it's kind of complicated and sometimes doesn't actually benefit. So I won't go into that because it's kind of quite a complex area. But, just think of the 7 years really as a rule of thumb. And
and I think we'll touch on it in a bit, but there is a surplus.
There is
income gift thing that we'll talk about later.
We will.
I suppose the other thing that we probably should talk about now that we're talking about inheritance tax is trusts.
Yes.
A lot of people think they know what a trust is, but it turns out they don't. It's quite fiddly. But essentially, you, as the settlor, you give away your assets to people who act as a trustee, and they look after the assets or the money on behalf of your beneficiaries, who are basically your heirs. Now, trusts have a very specific inheritance tax regime. In essence, there's a 20% entry charge when you put assets into a trust, which are above your nil rate band, so above your 325,000. And there's also this often misunderstood and often forgotten about 10-year anniversary charge. So there's effectively a 6% charge every 10 years when you've got a trust in place.
But still, it's a really good thing to use. A husband and wife or civil partners can put 650,000 into a trust for the next generation, say, and it grows inheritance tax free. And
I think trusts are absolutely great.
And it protects from, outside of tax, it protects from things like, if children get divorced, it's not part of their divorce settlements. It protects from any undue influence that somebody might have over somebody else. So they are
too much, too young.
Yeah,
we see
absolutely.
that all too often. A child of someone wealthy, age of 20, is given a couple of £1 million. I think that ruins your life.
It's life-changing, isn't it? And if it's not handled well.
And not in a good way. Whereas if you had a trust in place that could protect the wealth, and you could put rules in place that say, you can't spend this unless you're buying a house or setting up a business or funding education. So I like trusts. I think they work. You just have to be aware that there are tax impacts of it.
A bit of administration too with registers and things. But
But I like the idea of just lending to a trust. You could lend £1 million to a trust. It doesn't create this entry charge. And then any growth is outside of your estate. So when you pass away, there's no 40% on it. So there's a lot of things. There's a lot of things you can do with trusts. We'll leave it at that, I guess, or else we could be here all day talking about trusts.
Well worth looking into, though. Absolutely key to tax planning with inheritance in mind.
So I think the three big things. So that's the lay of the land inheritance tax before April 2025. But we had some big changes. April 2025, big changes for non-DOMs and UK long-term residents. April 2026, big changes for business relief and agricultural relief. So this affects family farms and small and medium-sized family trading companies and the patriarchs and matriarchs of those businesses. And April 2027, so this is the third big change, inheritance tax on pensions. So perhaps I'll start by talking about the one that's already now in force, April 2025. the abolishment of the non-dom regime and the introduction of this long-term residence concept. And I'm sure you're as aware of this as me, but domicile it's a very archaic system, and it's broadly based on what were your parents' intentions at the point of your birth. Were they directed towards the UK or elsewhere? And if your parents came from the UK, you were born in the UK, you almost certainly got a UK domicile. But if your parents were from overseas, there's a good chance that you've got a non-UK domicile. Now, the interesting thing about this was if you were non-UK domiciled, only your UK situated assets would be exposed to inheritance tax, UK inheritance tax. So that was quite valuable. And what a lot of wealthy people did who were from overseas, they kept a lot of their wealth outside of the UK, completely inheritance tax free. And then as they were approaching year 15, when you become effectively deemed domiciled, they'd whack all of their non-UK assets straight into an offshore trust, and there would be inheritance tax protection forever.
Valuable.
Well, it was.
Hugely valuable.
April 25, no more. We've now got this system which is 10 years. So if you're resident in the UK for 10 years out of the last 20, you're exposed to inheritance tax on your worldwide assets. Doesn't matter if your parents were from abroad. If you've been resident in the UK for 10 years, worldwide inheritance tax exposure. And what's worse, if you set up an offshore trust, suddenly that offshore trust doesn't get the inheritance tax protection forever. Instead, it's got the UK tax treatment, so the 10-year charges and all that kind of thing. So those people who've been in the UK for a long time, they're stuffed, really. And we were talking earlier about, what are the solutions?
Moving outside of the UK seems to be really, sadly, key.
Yeah, pack your bags and leave.
It's a sad state.
Pack your bags, get on Skyscanner, have a look. Popular destinations, Greece, Ireland, Channel Islands.
Dubai.
Italy, and of course, Dubai.
Bit of sunshine.
Everyone's moving to the UAE. And you've got to obviously handle that correctly. If you, that's a whole subject in itself. But a lot of these international wealthy families, they're leaving the UK
in droves.
Yep. I suppose the other thing that you could do is, if you're younger, you could look at life insurance.
Yeah, that's a really good option, because then if you've settled life insurance and you've got the amount to cover your expected inheritance tax liability, then you're not leaving it to the next generation who may have to sell assets to pay it. So life insurance is a really good option, certainly worth looking into, get some quotes.
Yeah. I suppose something that's perhaps maybe an unintended consequence is actually, because these new rules don't look at domicile anymore, it actually looks at your years of residence. Actually, the British expat community actually could be potential winners from this, because say someone worked in banking and they've been working in a little bit in America, and then they went to Hong Kong, then they went to Singapore, and now they're perhaps in their 60s, perhaps, and their kids are starting to have kids. They've got grandkids and they want to spend a bit of time with them, maybe they're 60s or 70s. They can come back to the UK and they've got 10 years before they trigger inheritance tax exposure, effectively.
Particularly if you're in poorer health and your life expectancy isn't great, that is a good option.
I'm speaking to someone at the moment who, very wealthy, very successful businessman, sold a big travel agency business, moved out to somewhere in mainland Europe. He's thinking, actually, I'm in my mid-70s now. I can come back to the UK. There's a good chance I might not make it to, my mid-80s. So actually, I'm probably going to be inheritance tax-free. Absolutely amazing. And he wants to spend more time in the UK.
Gives options, doesn't it?
Yeah. So that's April 2025. That's the abolishment of domicile and the introduction of this long-term residence. And the solutions for it, leave the UK is pretty much the best one. Well, let's maybe talk about April 2026. Business relief. I'm talking agricultural relief. So I'm talking trading businesses. I'm talking farms. And also maybe a little bit about the alternative investment market.
Yes.
Do you want to tell me a bit about that?
I'll start off with the businesses, the trading businesses and farms first, and family farms. And I think it's been a lot in the news, particularly with farmers lately, holding up bits of London with tractors and. I'm from Suffolk, and every time I go on the old A12 back to Suffolk, I see all these trailers in the farmers' fields, and it said "Family Farm Tax, must stop it." It's really emotive, and it absolutely is, because when you think, for generations and generations, a business may have been handed down, particularly farms, which are the home, the animals. There's a lot of love put into caring for your land and your animals, and it's been your granddads and their granddads before them. And suddenly with the next generation, the whole farm or the whole business won't go directly to the descent. Well, tax will come in the way. There's, instead of the whole lot being exempt, there will be £1 million per owner of the business, which will be exempt. So with a husband and wife civil partner business, that's a couple of £1 million of exemption possible, which, if the business is worth, say, 20 million.
So what happens on the remainder above $1 million?
It gets taxed at 50% of the inheritance tax rate, so 20%.
Effectively an inheritance tax of 20%, whereas previously it was 0.
Absolutely. And the business relief or the agricultural property relief is the £1 million is not a transferable relief. And so this is the one instance where we would say...
Between husband and wife, between spouses.
Yes, that's right. Yeah. And so the one instance we wouldn't say actually leave the whole of your business to your spouse. And I'll come on to what we can do about that a little bit later. But, if, for example, with, say, a widower who has a £20 million business, instead of the whole thing being tax-free going down to his children, there'd be, after taking off your 1 million exemption, there'd be £3,800,000 worth of inheritance tax to pay.
So this is a £20 million business. Yeah. It's a small trading company.
Yeah.
One patriarch owns all the shares. 1 million tax-free, 19 million at 20%. So £3.8 million tax exposure.
Nearly 4 million.
Previously, there was 0.
Yes.
How the hell is that? How the hell are they going to raise?
For many people, it's going to be selling off, if you can, part of the business. And often it's not viable to sell off part of a business. So suddenly the business is gone, it's sold, job losses. There's a whole heap of consequences for...
And that's trading businesses, isn't it? And farms.
Yes. Yeah. Trading businesses, factories, print works, little shops or bigger shops.
Yes.
But
anything. So it's trading companies.
Yeah.
So it's
not investment companies.
Pretty much anything that's not an investment. So investments are mostly property and, I don't know, financial stuff.
Yeah.
So that's huge.
It is. It really is. And where you were secure in, the legacy, your next generation's legacy, no more.
Yeah, so this is, I suppose the interesting thing is the small business owners haven't been able to organise themselves in protests in the same way as maybe the farmers have. So maybe we hear a bit less about that in the news. And I also saw something that said it's very difficult for the government to attack a profession that's featured in children's books because it's easily understood by people. And farmers is obviously one of those professions. Yeah, it's a tough one.
And, historically they're asset rich, but usually income poor.
Yeah, it's a very low yielding asset, I suppose. And should we talk about solutions? What can you do? Because these changes are coming in April 26.
If you can, put your business into a trust before April 26. So, kind of get a move on.
Or some of the shares in the business,
yes,
at least, yeah.
Because at the moment, if you do it before April 26, the business relief or the agricultural property relief would be at 100% of what you put into the trust. You'd get the full relief, so no tax going into the trust, and then it's within the trust, it's absolutely covered. So that could be a huge saving. Obviously, has to work within the parameters of the business and of the other owners of the business, but it's certainly something to start thinking about, talking to your advisors about.
If you're thinking about setting up a family trust anyway for all the, for the asset protection, the succession, the too much, too young reasons anyway.
Keeping the business going.
you may as well put, some of your wealth, which is in the form of your family business, into a trust.
And definitely now.
Yeah,
The power of now.
Absolutely. And what else can we do? There's something about the spousal exemption, isn't there, with wills?
There is, and basically, as I mentioned, this particular 1 million relief isn't transferable to the spouse if you're leaving everything to the spouse, and so one way of making sure that if you're not going to put it all into a trust now, that you use up each owner of the business's 1 million is by putting a clause into the will to set up a business relief or agricultural property relief trust using that 1 million, so that on the first death, the trust's set up, the million relief is banked, and then on the second death, you've got a kind of mirrored situation in the wills, and then on the second death, the other million goes into the trust. So even if the actual property isn't within the trust, you've kept your 2 million.
I suppose if we compare the scenario, if you don't do this type of planning, the second death, there's only 1 million.
That's right. So you're losing a million of relief.
So you're losing 1 million of relief. And because the new rate of tax is effectively 20%, if you don't put this in your will, you're basically handing £200,000 to HMRC when you don't necessarily have to.
No one, and especially when it's a business, bread and butter, not even just excess assets that you've got, but
sounds like an easy way for families to save money.
Definitely.
If they just plan properly.
Definitely.
And what should we talk about? AIM,
yes,
alternative
let's do
investment market.
And the AIM shares, it's obviously you've got the FTSE, and AIM shares are a lower tier of.
Should we call them the championship?
Yeah.
The main stock exchange. That's the Premier League or the Champions League or something.
I like the analogy. So yeah, absolutely. And AIM shares have always been deemed to be a bit riskier, hence the tax relief that's been there, and they've also benefited from the business relief at 0% inheritance tax.
So essentially, it was as if they were exempt from inheritance tax
Absolutely.
or fully relieved from inheritance tax.
And so it was a good, especially as people get older, a really good investment, even if they were a little bit more risky. The advantages of the tax relief were great.
Yeah, 40% saving.
Whereas now there's no £1 million relief on those. They're taxed fully. They get a 50% discount on the AHT rate. So effectively they're taxed at 20%. So if you've got an AIM holding of 1,200,000, tax will be.
So I don't think there's really any solution for this. It's just bear in mind that yes, there's still some. Then they're paying they're exposed to inheritance tax at 20% rather than 40. Exactly, rather than at 40%.
But not the zero that we have been used to.
Well, it's
all bad news.
I don't know. Do we have any good news?
We've got some solutions, haven't we?
I think so. And I suppose the next thing we probably should talk about is pensions.
Yes, another zinger of change.
Yeah, so pensions, it's an interesting one, isn't it? Because previously pensions, absolutely brilliant for tax purposes.
Yep. Everybody were told, keep the pension till last. We're talking about here the defined contribution pension, where the pot mounts up with the.
It's brilliant though, isn't it? Because you've got pension, you've got tax-free growth, so there's no income tax, no capital gains tax while assets are within the pension wrapper. And then when you pass away, there's no inheritance tax either. No. So if you talk to your independent financial advisor or your IFA or whoever, anyone financial, they would say, or your tax advisor, without a shadow of a doubt, leave your pension until last. Use up all your other money, sell all your other assets, keep your pension intact. Now, April 2027, what they're proposing is pensions become exposed to inheritance tax. So this completely is switched on its head.
Puts a kibosh on the whole lot, doesn't it?
Yeah. There's a trap in there as well. We've talked about it previously, but it's if you're over 75 and perhaps you're a widower, so we're ignoring the spousal exemption. You're a widower, you're a widow, and you leave your pension to your kids. There's 40% inheritance tax. And because you're over 75 when you pass away, there's also up to 45% income tax for your heirs to actually access that money. So imagine you've got a £1 million pension pot. You've got 40% inheritance tax, 45% income tax. Effectively, combined together, it gives a 67% rate of tax. So your £1 million, 330k in your heirs' bank accounts at the end of the day. So you're giving £670,000 to the government.
It's huge. It really, really is. And there are ways we can start to think about avoiding it, or to a big extent avoiding it anyway.
Yeah. Perhaps now is a good time to talk about gifts out of surplus income, regular gifts out of surplus income, because this is a tool I'm talking to a lot of clients, and so are you.
And particularly with pensions. Broadly, the regular gifts out of surplus income, as the title would suggest, need to be regular. And regular can mean a fixed pattern, so maybe monthly, maybe quarterly, maybe annual payments. They can be regular amounts, but they don't have to be, but they do need to form or be expected to form a pattern. So if you decide to take perhaps the pension and your pension nets you, say, another £2,000 a month that you're not needing because you didn't have it before, you could then gift that net income, that £2,000 a month, to your heirs, and starting it off with a letter telling them what you're doing, so that if anything happens after you've made the first payment, the intention for these to be regular is there. It's fixed. And
I think the key thing to emphasize about regular gifts out of surplus income, unlike other lifetime gifts, which we talked about before, is you don't have to survive 7 years.
No,
they are immediately outside of your estate for inheritance tax.
They absolutely are. And so they are a brilliant tool. If you've got excess income already building up, start doing this. And if you haven't, but particularly if you're reaching 75, then start thinking about taking your pension, because although it'll be subject to income tax, you're not going to get that double charge if you start gifting it away.
Away the pension income to your heirs.
And the other bit that we talk about here, the surplus income, what you do have to do is maintain the lifestyle you had beforehand. So it wouldn't work if you've been used to having sort of 4 holidays a year, and you decide to use that money, that wouldn't work. You need to keep your regular lifestyle. You can't downsize your property to give that away. Yeah. So keeping your same lifestyle. It could be subject to a challenge by HMRC, so keep good documentation on what you're doing. I mean, that's key for anything within tax and legals, you know.
Well, I think inheritance tax is a weird one, because actually the tax happens after you're dead. So you're not there to defend your position. You've got to make sure that you've got enough paperwork or evidence, contemporaneous evidence in place that your heirs are able to defend your position, because
and
people
are already grieving, hopefully. But you know, and it's a difficult and emotional time. So the more documents that you've kept, the better it is for them to be able to do just that, and make sure that your wishes are just that, and they're not taken away by the government.
So we've got April 25, non-dom, long-term residents. April 26, BPR, APR, the agricultural relief, business relief, hitting the farms and the families, and the AIM. April 27, pensions. I guess there's some other. There's one other particularly good bit of inheritance tax planning that surprises some people, and it's not related to any of these changes, but it's get married.
Yes.
It's a weird one, but married couples are treated so much better.
They absolutely are.
For inheritance tax purposes, the spousal exemption is so good.
And if you've lived with somebody, your life partner, for a number of years, and you know, even if you don't believe in marriage, there's always civil partnerships available, both to heterosexual and homosexual couples. So you don't need to actually have the religious element, or even the sort of marriage,
cultural, institutional stuff. So I'm advising a lot of clients who and friends and relatives, in fact, that you're basically living as life partners. Why not become civil partners or get married?
And when you add up the tax advantage to doing that, it really becomes a sort of no-brainer, really. You know,
And
being able to pass something.
It's pretty much the only bit of inheritance tax planning you can actually do on your deathbed.
You can. Jade Goody is a sort of
famous
cultural example.
example.
And it really does work, difficult times. But the spousal exemption is powerful. Being able to give everything to a spouse and no inheritance tax. And then on the second death, you've built up the 2 lots of the nil rate ban. So you've got 650,000 available on that second death for what passes down. You've still got all the gifts available that we've talked about before.
It just came into my mind, but I suppose when you're talking about the spousal exemption, I think this is why it's so important to have your wills written properly, because you might want to create a life interest trust for the surviving spouse.
Definitely.
With your children from that marriage as remainder men. So if your surviving spouse does remarry, your kids don't miss out on their inheritance.
Yeah, blended families, obviously such a big part of everyday life now. And it is really important because, obviously once you're gone, particularly if you're younger as well, then there's every chance. And, most of us would want our surviving spouse to be happy and to build a new life. But
not to the detriment of your children's inheritance.
And the trust can be put there so that the surviving spouse, as you said, Kieron, gets a life interest, which means they can carry on living in the family home. They can get income from the trust to continue living their lifestyle. They can get capital distributions subject to what you put in the trust.
I like trusts. I keep saying it, but trusts are really, really powerful kind of planning tools.
Absolutely. And all the legal protections we've talked about in difficult circumstances, they're there for that. And they work so well. Big, powerful thing to use, trusts.
I suppose, I don't know, we'll start to wrap this up a bit, but I'm whenever we talk about inheritance tax, I'm always reminded of Roy Jenkins. So he's the former Labour Chancellor. In 1986, on the subject of inheritance tax, he famously said, "It's broadly speaking a voluntary levy paid by those who distrust their heirs more than they dislike the inland revenue."
I hadn't heard that before. It's a brilliant quote. And
I think it rings true still today.
Absolutely.
Because if you plan, inheritance tax is kind of optional.
Yep, totally. I mean, there's so much you can do if you've, be prepared to put a little bit of work in, talk to some advisors and...
get advice early.
Yes, absolutely. Never too early to start doing this. Don't leave it too late.
Yeah. So why don't I ask you, have you got 3-4 tips on what people should be doing to deal with inheritance tax?
Firstly, inheritance tax, and generally make sure that your will is up to date. Review it, update it, make sure you've got letters of wishes as well that sit with the will. Life insurance, go and get some quotes. Number 2. Number 3, if you're a business owner, consider putting business assets into a trust, particularly pre-April 26. And start making gifts, both the chunkier gifts that need you to survive the 7 years. The earlier the 7 years starts kicking in, the more chance of success.
Yeah, start that clock early.
Definitely. Be early to avoid disappointment. And also the other gifts, the gifts, regular gifts out of surplus income. Start them early, document them, and
excellent.
Get giving your money away.
Is there anything else you want to speak about today?
No, I think probably we've covered a lot of inheritance tax, given a lot of thought.
Yeah, it's a tricky subject, but if you plan early and you get advice, it doesn't have to be that painful.
Absolutely.
Well, thank you very much.
Thank you, Kieron.